you have the same responsibility, to your point, Emily, whether or not you're a director on public or private, it's the same responsibility in terms of governance. So is this then contributing to efforts to increase the focus of governance within the private capital space? Is this just one of many contributors, or is this the primary driver?
Yeah, I don't think we're at an inflection point where, to Emily's earlier point, that a lot of things are different, right? I think that the general nature of serving on a private company board has been pretty similar since the great financial crisis, right? Do you have a good strategy? Are you observant of potential conflicts of interest, either between manager, between related party entities? Uh, or others or dependence upon your clients. What's the overall risk that you're taking? And are
Mhm.
you taking that risk for the right reasons, or are you just naturally exposed to it and it's unmitigated? I mentioned capital structure. And lastly, as a director, you above and beyond all of your technical expertise and the experience that you can bring to bear, you should have some market influence as a director. Can you help with customers? Can you help with contracts? Can you help with understanding various markets? So I think all of those issues are issues that are still in play in your board meetings. The one big difference that's always present in private companies versus public companies, the elephant in the room in a public company is time, right? You have to report out quarterly on everything you do, and you get a report card every day in your stock price. And
Yeah.
that's always in everybody's mind because that information and the informatics around that are so prevalent. Almost everything that happens in a public company is pegged to that. Compensation is pegged to it. Strategic capital investment is pegged to it. And the big difference on the private company side is you don't have that clock sitting at the table in the same way. Sure, the
Wait,
private,
hold on, Robert, because at the same time you kind of do because you know this is a limited investment, right? It's
yeah, but
going to be
it's
3, 5,
different.
7 years if you're in a fund right now.
Fair point, Michelle, but it's different when you have, think about in your own life, when you have 5 years to do something versus showing the discipline and the
Like three
trend of
months.
doing it every quarter, right?
Yeah.
It is a very different behavior. You can, for example, decide to have increased CapEx in a private company and realize that, you know what, this is going to squash our EBITDA for a while, right? But we're going to come out of it a stronger, more capable company. If you're going to do that in a public company, you've got a lot of pronouncements to make to the marketplace. Depending upon the size, you better be talking to the analysts out there because you can literally ruin that company if the marketplace doesn't know why, for example, your cash flow or your income is down because you're spending CapEx. So just an example.
Yeah. Okay, that makes sense. Emily, anything on the increase in governance and private capital right now?
Yeah, I would say that something that maybe Robert hadn't touched upon is that typically in private equity or venture, you have the investors at the table. They're they have analysts that are going through and for the fine tooth comb the financials and understanding all the financial metrics and digging into strategy a lot more than in a public company. I mean, yes, there is a little bit of the market telling you, do people agree or not agree? I think it's difficult today or maybe in the last, I'm going to say 6 years in regards to the sentiment in the market because there's things that are perception based and not based on good sound financial results. There, but in a private company setting or private capital setting, typically you're going to have a founder that's there on the board, as well as representatives of the either private equity or venture fund, and so they do have a voice and they're able to be more involved. Sometimes, a little bit more when there's not certain experts that are at the company. So there's a missing leader, for example, a finance leader. Some private companies don't have CFOs. And so the venture capital fund has to have a little bit more depth in regards to looking and scrutinizing the financials. So I mean, I think that Robert captured everything, but the only thing I would add is that you have to consider that the people are at the table that actually have invested heavily into the company.
Yeah. Yeah, which is definitely a difference. We always hear the old adage for public companies, it's noses in, hands out. Yeah, it doesn't feel like that's the same on the private side, on private equity or venture capital. There's a lot more involvement on a day-to-day basis. So not day-to-day, but a lot more involvement. Sometimes day-to-day, depending upon what's going on in the
Yeah, if there's a
organization.
transaction or
Yeah, if
some
there's a
pivot
transaction.
point. Hmm.
Exactly. Um, is that typically true though? So maybe you can tell us a little bit about what is it more like to be a private director?
Yeah, I'll just start in terms of the difference. I mean, the governance standards are very similar, and especially if you're independent going on to a private capital board or portfolio company, you still have your duties that you need to think about every time you're in that boardroom. You're no longer representing yourself. You're considering the stakeholders, but there is a mutual respect. So if you're joining a portfolio company board, you need to feel comfortable that they're going to respect your voice in the room, that you're not always going to just be overridden. So there's a lot that goes into that in regards to interviewing, not yourself being interviewed, but you interviewing the investors that are that are selecting you for an independent board position. And so just understanding that dynamic is really important. No, and then there's also the idea of understanding who the majority vote's going to be, right? So there's a lot more diplomacy and understanding of the different ways and perspectives that people are coming at a problem at a company, maybe not a problem, but a strategy, and making sure that you have that in mind. But at the end of the day, you vote your vote, and it's based off of your own experiences as well as what you believe is best for the company.
Yeah,
Yeah, I think Emily covered most of it. I'll just sort of frame out who's around the table.
that'd
So,
be great.
in an early stage company, there's no question that the founder and maybe co-founders will both be directors of the company sitting at the table. And as I bring each one of these characters onto the table, I'll talk a little bit about how you have to treat them. There's a lot of respect, at least when it's a healthy environment, that needs to be paid to the founders because this is their baby. They've got generally a lot of emotion and a lot of their capital, their personal wealth tied up into it. And what I try to do in a situation like that is constantly measure the decisions and the feedback that they're giving you with their emotional connection to it, right? People issues are often very difficult to deal with around founders because there's always some favor that someone has done or some debt of loyalty that someone has shown that comes up that's frankly not always within the fiduciary boundaries that you as a director hold. But it's important to deal with founders in that way. Unfortunately, when the company struggles, it changes, right? How that founder gets dealt with and handled changes because you may be in a transition period or there may be a pre-transition that, is not, fully known by all of the board members yet. So that's one set of issues. The next would be the lead equity holders, right? The
Hmm.
private equity, venture capital firm, family office, whoever that is. It's pretty obvious who they are because they're going to have oftentimes the last word on most things because it's their money that's being brought to the table. Again, respect for everyone. But in a lot of cases, you need to figure out where the equity investors, the lead investors are driving and pushing and what they want to see. And then you have to measure that against your own experience, expertise, frankly, integrity to make sure that, to Emily's point, you're either speaking up in support or against, or attempting to, in some nuanced way, move the conversation in a different direction. The other two groups, I'll say quickly, are other independent directors, people like you that, may have some equity interest, but it's not a majority or an overriding equity interest. They're typically bringing expertise. And then the last group would be, in some cases, the private credit or by covenant, certain debt holders that will want to sit there either because the company has taken on a lot of debt and they want to protect those interests, or they somehow hold, a convertible note or mezz capital that gives them certain rights as well.
So the one I didn't hear you go into detail on was, and again, I'm going to compare and contrast to public and private, is the CEO. So
Mhm.
if it's a founder, yes, but if it's not a founder, if it's gone beyond founder and the founder has either moved to the board or moved on, and you have a new CEO who's brought in by the fund.
Yeah.
Um, how different is that relationship between the directors and the CEO in private versus the relationship in public?
Yeah, what I've found is in most cases, when the CEO is also a board member, they are constantly doing this lean in, lean back in the meeting. Both Emily's laughing because she knows what I'm talking about. A lot of times they're giving the operational report. They're telling you what the company's doing and they're, executing against the strategy. And typically the board has had a voice in at least approving the strategy. But there are also moments where they need to lean back, right? When it's, compensation, they often have to
Mhm.
make a recommendation and lean back. When it's evaluation, they're telling you based upon their engagement with the person, but you ultimately are going to hold the authority to evaluate the CEO to determine whether or not they qualify for their bonus, whether or not they qualify for their equity, measuring against the marketplace. So yes, absolutely. When the CEO is on the board, for sure. One of the more challenging times is when you have either a new CEO or a CEO that it's been determined is going to be moving on. And those are sort of white knuckle moments where the boardrooms can get pretty testy if people aren't in line or if things are not progressing according to the company's plans. Though that's really a time when the board meetings are a little bit more engaging than if everything's going well and it's steady as she goes.
Good. So that's one area where the board is probably going to get really involved. How involved is the board going to get in strategy conversations and macro environment conversations? Is that a fairly typical um, part of the conversation as well?
I think it's one of your top priorities as a board is to obviously listen to what management's put together based on a knowledge deeper than what the board typically can go into, and bringing it to the table. Are there risks associated with this? Are there opportunities that we're not thinking of? So it's one of the number one priorities that we have as board members is understanding strategy. And typically the strategies are considered long range, but in today's age it's really thinking about it every single meeting, and also understanding a lot of the threats that are coming against the company's strategy.
So the
So
reason I ask you that, Emily, is because it isn't the strategy already set by the firm when they make that acquisition, when they are deciding on their thesis, they're already, they already know what they want to do by the time that they exit this in 3 to 5 years, right? So how much influence really is there on strategy as much as the board needs to understand it and be driving the CEO and the team in that direction? That's why I
yeah,
ask.
yeah, no, absolutely. I mean, I think it can change on a pretty regular basis, especially because of the rate of technology and the competition that's out there and the changing environments. I do believe that talking about strategy at not just the overall level. Oh, well, we're going to exit in 5 years,
Yeah,
and
of
we're going to
course.
be selling these widgets. It's getting deeper into how are you going to execute? Do you have the right team? Are you considering the appropriate risks? And are you thinking about advancement or improvements? all of those things are part of our normal conversation. So I think it's something that we talk about on a regular basis. Now, on private companies versus public, most of mine meet quarterly still, just because that's a good way that the CEO can present what they're thinking and getting the feedback from the board from different perspectives outside in, typically. And I think that that's a very good cadence. Maybe every 6 months was something that was appropriate years ago, but it's really a lot more than that. And when we talk about the cadence as well, um, as board members, we're responsible for also keeping in touch with the company between meetings and understanding whether or not there's something going on, or just checking in. I check in pretty regularly with the CEO and CFOs of my boards that I'm on, just to make sure, is there anything when you think about me that because they know what framework I'm looking at it. I do look at the company from an industry perspective, and I sit on different boards, but they also understand that I'm in more in the finance area. So something might come up that they didn't think about, and just start, a good conversation.